These are the very early stages of disinflation. Our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time.
And that was Federal Reserve Chairman Jay Powell yesterday on the need for more rate hikes. Markets liked his comments overall, I guess suggesting that maybe we are close to the end. They finished higher. I've been questioning this reaction. Up 265 on the Dow Industrials. The Nasdaq was up 226. This morning we were looking at a pullback, however. The Dow down 138 now and the Nasdaq down 51. Joining us right now is Federated Hermes Chief Investment Officer of Equities, Stephen Auth. And Stephen, it's always a pleasure to see you. Thank you so much for being here. What was your takeaway from the Fed chairman commentary yesterday? And let's just point out that he also said, quote, disinflation will be bumpy.
Well, it kind of fits with our rocky landing idea, Maria, as you know. Look, I mean, this time last year, it's hard to remember this, but the Fed had rates at 25 basis points, the Fed funds rate, telling us it was going to be transitory, the inflation problem. And the market had the 10-year at under 2%. So neither the Fed nor the market, the bond market, has been a particularly good forward indicator of where things are heading. So, we're more focused on the next 12 to 18 months. We think we're getting, the back half of this rocky landing, but we don't have the Fed cutting anytime soon. We're not sure when they stop. We think the market's going to be kind of trading in a range here between 3,400 on the downside and 4,400 on the upside. We're closing in on the upper end of that range right now. So we're telling investors, lean into stocks, stay cautious though, and stay defensive in stock portfolios. So
what do you make of the earnings period? Because we've been expecting a slowdown in earnings and the macro story. But I think a majority are actually reporting better than lowered expectations. We had CVS and Uber both reporting double beats this morning. Disney, of course, is coming out after the bell, Stephen. But what's your take on the earnings picture and the macro story? Do you still believe we will see a recession this year?
We're calling it rocky landing, Maria. I think we've been bouncing around zero for the economy for the last 12 months and in kind of the same way going forward. I don't think it's going to be a harsh financial crisis like we had in 08-09. So I think that's the good news for investors. But we're in a kind of difficult period. The earnings, as you pointed out a few times on this show, heavily dominated by, the energy companies have done really, really well. And the rest of the market's done okay, and the tech companies are doing terrible. And their numbers keep coming down. They've had their second big round of earnings negative surprises here this quarter. We think there's at least another leg out there. So those stocks, which are still a big hunk of the market cap of the indices, we think have some more down legs in them, and valuation-wise are expensive. So we're leaning into defensive stocks here, dividend payers. We recently added to Japan and Europe on the international side. We think that those economies are starting to bottom out, and the stocks are a lot cheaper. But, we're not rushing after some of these growth stocks that have been really bouncing hard. Yeah. And I guess the idea that the news has not been horrible, but I think, I don't think they're going to recover anytime soon. They brought so much revenues forward during the COVID lockdowns. Okay. Even they, I think, don't fully understand just how much was pulled forward from future years, and that's all sort of coming out now.
Yeah, and now it's coming home to roost. James Freeman jumped in because this morning Zoom is saying it's laying off 15% of its workforce, company preparing for what they're calling uncertainty of the global economy. eBay cutting 4% of its workforce, largely for the same reasons, James.
Yeah, but still a good overall job market. And Steve, I want to get your thoughts on Jay Powell, because you mentioned a year ago he and other Fed folk were talking about transitory inflation. Rates were at rock bottom. They did recognize the problem since then. Last 12 months, rates coming up 4+ percentage points. Do you feel like, even though you're seeing a rocky landing, maybe that's kind of inevitable, do you feel like Powell now has a handle on the situation? Is he making you more confident with his recent actions, or do you think they're still kind of clueless and wondering what comes next?
Look, I think he is relatively clueless. I think he's figured out that he's got a supply problem, and that hasn't been fixed. And by the way, we didn't hear anything about that in Biden's speech last night. I mean, I love the president's death, but his staff, they're just not focused on the supply-driven problems in the economy, the lack of labor, the lack of investment in commodities and energy. Everything they've done has been the opposite of that. So neither side here really completely get it. And I think Biden has figured out, though, James, that he's got a supply problem. I think he understands that much more than the president does. And he's got the 70s playbook in front of him now.
Yeah.
He didn't have it a year ago when people like us were screaming at him to open that playbook up. And he knows he can't cut anytime soon. With a supply-driven inflation problem like this, it'll come right back. So I think we're in an environment here of rates higher for longer. I'm not buying the pivot or anything like that. So I think growth stocks are going to struggle, but I think you can do okay with dividend-paying stocks.
Stephen, it's great to see you. Thanks so much for your insights on all of that. Stephen Auth joining us this morning.